Hey everybody, Marty Missouri here. It's Tuesday, the 9th of January 2024, about a half hour before the market close. This will be, we'll call it your midweek market update. Clients, this will be your Wednesday message as well, so it'll come to you via email in the morning. So, big rally yesterday. I talked about it on the written blog this morning. Seemed to be catalyzed by NVIDIA's announcement that they've got a new product line, AI products for personal computers that are going to be special. And I think a lot of folks were positioning short big tech. I would say rightfully so, given valuations and given our outlook right here. And I think that probably forced some panicky buying, short covering. There's some liquidity out there that can buy stocks for sure. And after last week's, again, notable sell-off, all it needed was somewhat of a catalyst. And, again, I think there was a fair amount of short covering. I also believe that in the derivatives world, there's probably that kind of an upward spike broke through some levels to the point where dealers would have to hedge against a big upside move or a continued upside move, and that exacerbates the upside as well. I know that gets into the weeds. We talked about this a few times last year. That is not an uncomplicated subject, but make no mistake, folks, it is a not small influence on the day-to-day movement in these markets. In terms of the next short-term catalyst, look for Thursday's CPI to potentially move the market. If we have hotter than expected or higher than expected inflation per that metric, stocks are likely going to sell off. Tech probably more so than the rest of the market. If inflation comes in lower than expected, expect the market to rally. So folks, this remains the character of the market right here. And that is not the character that we anticipate if indeed we're going to see one last leg down to this bear market. That would come as a response, as I continue to express ad nauseum, in fact, as a response to actually lower yields, lower inflation, consistent with a recession. And with that comes dramatically lower earnings than what is presently priced into the market. And that's where the risk is right here, frankly. However, there is short-term downside risk if indeed economic data comes in better than expected and inflation comes in hotter than expected. The market is anticipating several rate cuts this year. We think that makes sense because we think the economy is still subject to slowing this year more than the market's anticipating. And when I say the market, this is what's priced into Fed funds futures when I say the market's anticipating more cuts this year. And then when I say the market isn't discounting it, that's the stock market I'm talking about. And if we get this proverbial soft landing, which I think is very low odds, but if we did, that can be problematic in a sense as well, because in a soft landing scenario, inflation doesn't continue to roll over. Inflation finds a bottom, probably begins to tick back up, should bring the Fed back into play on the tightening side of things, and then ultimately that could be the last tightening before the inevitable recession. Of course, a recession is inevitable. It's just a matter of, are we actually going to see it in the course of this year, or are we going to have that immaculate soft landing and survive this year, and then it'll be a problem, going forward after 2024. Of course, all that remains to be seen, but we think there's enough risk of that playing out sooner than later that we need to continue to be somewhat cautious right here. Let's go ahead and jump to the technicals. In front of you is the daily chart of the S&P 500, and folks, this remains a bearish chart. If we do break down below this pattern right here, that's a pretty classic looking bear flag pattern, and that would take us right down here to what has been, or what would be, I think, some pretty good support, because it was pretty good resistance since the July high, and then for 2 or 3 weeks here in late November, mid to late November, before things broke out in early December. So that would be a key area to maybe game of bounce if you're a short-term trader. If indeed we do break down, we could easily come back and test these levels lickety split though, which were just right near that high. Now that will not, particularly if it happens soon, that will not be enough to burn through these bearish divergences. So this bearish look on the daily would still be there. Looking at the weekly chart, and I did some of this here during the last video over the weekend, I just want to take a look at the 10-year weekly chart because, folks, this is the definition of a bearish look. So we have a rising wedge pattern. Keep in mind each bar is a week, okay? And very definite bearish divergences here, and you can see, you know, before what I think is still a bear market, you had a rising wedge pattern, right? And you had bearish divergences, right? Look very much like the situation we have right here currently. Just like here at the bottom in October, we talked about a bounce right here, and we've gotten it, and it's lasted longer than I expected, to be honest with you. But you notice we had a falling wedge pattern, and we had very bullish divergences right in here. So we have the opposite of that here, folks. We have what looks like in many dimensions, more than just the technicals, the kind of setup we had going into 2022. So just to make you aware of that and support the notion that it would be important to be somewhat careful right here, hedge, what have you. As for the NASDAQ 100, or the ETF that tracks it, I have the weekly chart up here. Don't have a lot of lines that I've drawn, but I can do some of that right here. Just again, same setup that I showed you here on the S&P. In terms of the daily look for the NASDAQ, it's been all over the place. I think it was down about 1% this morning. It's up just barely right now, 0.09%. S&P is down 0.25%. Again, they've been in the red, in the black, even now for the Qs or the NASDAQ 100, and down a bit for the S&P. Rising wedge pattern. We break below, looks almost identical to the S&P, but above the 20-day moving average. Would not surprise me in the least to see us come up and test these levels again, but you've got very noticeable bearish divergences here, so that will not be a good look, or certainly not a signal to go long right here in my view. Russell 2000, remember we were looking right here, dancing along this very important, which is a 50% retracement from the peak line, and I said it would not surprise me to see a bounce, and we did see a bounce right off of that. And again, of course, we've seen it yesterday in the particularly in tech stocks, but we saw it pretty much across the board as well. And again, small caps, pretty bearish look. The small cap VIX has remained elevated well above 20. That's a bearish signal as well, which has not been the case with the S&P 500 VIX, which most people are familiar with, or even the VIX that tracks the NASDAQ 100 index. It's at 16.6. The VIX itself is at 12.8. 16.6 isn't low, but 21.7 is high. So that's a risky setup for a small cap index that has kind of gone to the moon here of late. So we'll see. Time will tell. Absolutely, unequivocally, we could see more of an upside bounce right here. I think that would happen if we get a soft CPI number on Thursday. As for yields, we flagged this as being bearish for the stock market. I was telling you this is a bullish setup back in here before it broke out, because we had this pattern and these divergences. And sure enough, we've broken out here. So we'll see how that plays out. It does look kind of like a bear flag, though, too, as well. So if yields roll over, there could be quite a bit of downside. That would be very bullish for stocks, by the way. Also flagged the dollar as problematic in terms of the pattern, and sure enough, that played out. Folks, this again was consistent with last week's notable sell-off in stocks. It was a rising dollar and rising yields, and today the dollar is actually up 31 basis points, and I'm sure that's somewhat of a headwind for what was the attempt at a rally here earlier today. Okay, so I wanted to take a quick look at Apple. Biggest market cap on the planet. This is the 1-year daily chart. Apple is a concern, and I pulled it up today when I listened to one of BCA's analysts talk about a story that was way back in the pages, so not a front page story, about potential antitrust issues going forward with Apple. I do think in today's society, we talked about the labor-friendly regime that we've morphed into and what that means for inflation and all kinds of other things. We spent quite a bit of time on the blog exploring that and looking at history. And part and parcel to that is kind of an attack on big business, the redistribution flare and that sort of thing. Now, it is an election year. One thing that the government does not want to do is crash big cap tech because it's so influential on the rest of the market. In fact, it was pretty much the market last year in terms of the rally. So I don't know how aggressive they'll actually be this year, but nevertheless, there is something to look at there. At least it was brought up. So that inspired me to update my Apple chart. And as you can see, it's not a bullish look by any stretch. There is a gap right here. It would not surprise me, frankly, to see that gap get filled, but you will not even remotely come close to burning through these bearish divergences. And let's just look at this on a weekly basis as well. Boy, yeah, this is just utterly, the way we look at the technicals, a bearish look, and that's a sell signal on the weekly chart. So Apple's very influential. You should look at this as a risk to the overall market. You can see we had a similar setup running into this, right? You had higher highs and you had a very notable bearish divergence. You got your sell signal and you got that 2022 pretty notable sell-off there. Here at the bottom, right, you had a downward sloping wedge and you had bullish divergences here, and you've had quite the rally off of that. So these conditions have flipped. Remember what I said, that this setup for the market, and here indeed for Apple, looks more like it was going into 2022 than it was going into 2023, for what that's worth. Lastly, wanted to take a look at this now. It's interesting because when I pulled up this chart, stocks were actually higher. The S&P was. It's down 0.25% now. And I just want to show, even then, actually the breadth was a little bit worse. There were only 3 sectors in the green and 8 sectors in the red. So right now the S&P is down. It's only down 0.25%, but 75% of the stocks in the S&P are down. You can see here 25% are all that's up, right? 24%. And this is, again, I said it's down 0.25%. Tech's up a hair, but 32% of the stocks are up. So 68, call it 70% of all tech stocks are down, even though the index is up a little bit, or the sector is up a little bit. Healthcare, flat, which makes sense. Half the stocks are down. Consumer staples, 60% of the stocks are up and it's flat. Remember what I said this morning. Last week, the top 2 sectors actually were healthcare and utilities, but staples were actually one of the 5 sectors. There were 6 down, 5 up, and staples and healthcare and utilities were 3 of the 5. Typically, that speaks to potential weakness in the economy. They tend to outperform when the economy is weakening. So we'll keep our eye on that going forward. So folks, I think, come to an abrupt stop right there. So again, clients, this will be the message in the morning. I'm trying to just keep it to 1 post a day. There'll be probably a written post on Thursday, another video on Friday. If I can, I'll combine the economic update in that one as well. Hope you have a wonderful rest of the day. Thank you as always for watching and listening, and I'll talk to you very soon. Bye-bye.